if you were thinking about buying gold or thinking about buying silver in January at the peak, with silver, you can buy the same ounce 40-45% less, and the correction has already taken place. I mean, it's not possible for because they can't default, they can't go to zero. And if you look at the demand side, the physical market, the real market, paper markets are the tail. Physical markets are the dog. The tail for years and years has wagged the dog. But if you look at the physical markets, silver's got a 450 million ounce per year deficit. And in the words of Elon Musk, you can't short a shortage. And that's what's happening at this point. So once this episode is done, you're going to see, I think it will only probably take 60 to 90 days. You'll see new highs in both gold and silver.
According to Bill Holter, we are entering a phase where trust in fiat currencies and financial institutions may begin to erode rapidly. In such an environment, assets tied to the system carry significant risk because they depend on someone else's ability to pay. Gold and silver, however, exist outside of this structure. They are tangible, finite, and free from counterparty risk, making them a potential safe haven when confidence in paper assets fades. As global debt levels continue to climb and servicing that debt becomes increasingly difficult, the possibility of widespread defaults grows stronger. Holter emphasizes that the real danger lies not just in market volatility, but in a systemic failure where liquidity disappears and credit markets freeze. When that happens, the illusion of stability vanishes, revealing how dependent the system truly is on constant expansion. In his view, preparing for this shift means understanding the difference between assets that rely on promises and those that hold intrinsic value. Now we present key insights from Bill Holter's interview. Before we continue, make sure to subscribe to the channel and turn on notifications so you don't miss future updates. Enjoy the video.
I mean, they've said, don't get into gold, don't get into silver. It's so volatile, and they've said it forever. And I guess, go back to the year 2000. They're telling you, stay out of gold at $300. Don't buy $4 silver. It's just too volatile. Well, guess what? Yeah, it was volatile. It was volatile to the upside. I mean, gold and silver have been the best place to have money since in this century. And it just sits there and sleeps and cannot default. Well, first off, and let's go back to what do you say to these people? First off, gold and silver don't do anything. They don't go up, they don't go down, they don't eat, they don't argue with you. You get to sleep at night knowing you're not going to default. What happens is the currencies go up and down, and that's reflected in the measuring stick, in the yardstick. The yardstick is gold. And what the yardstick is saying is that, okay, I mean, going back to the year 2000, and let's just use $300. The yardstick says that the dollar has lost 95% of its value, whatever the math works out to be. Since the year 2000, the dollar has lost that much. You could buy 1 ounce for $300, or $1 was 1/300th of an ounce. Now $1 is until a couple days ago, is 1/5000th of an ounce. Now it's 1/4500th of an ounce. So I mean, it's gone up 15-fold if you look at gold going up, but that's not what happens. It's the dollar going down. Well, gold and silver, and I said in January, gold and silver were due a pullback, without a doubt. And the pullback has been aided by naked paper sales. I mean, the naked paper sales have been used since 1975, since the COMEX began. But they really learned. They learned in 1987 when the market crashed, because a whopping $6 million is what saved the system. The only options that were open, I think, were not the S&P 500. It was Value Line, or one of the smaller ones, and $6 million went into that, and it saved the market. And what they figured out after that event was that they could bully markets with derivatives to make them go up or to make them go down. And that's what they've done. And I mean, there's proof of that. JP Morgan paid $920 million for bullying silver from 2005 to 2013. They paid $1 billion fine. Just understand that if you were thinking about buying gold or thinking about buying silver in January at the peak, with silver, you can buy the same ounce 45% less, and the correction has already taken place. I mean, it's not possible for because they can't default, they can't go to zero. And if you look at the demand side, the physical market, the real market, paper markets are the tail. Physical markets are the dog. The tail for years and years has wagged the dog. But if you look at the physical markets, silver's got a 450 million ounce per year deficit. And in the words of Elon Musk, you can't short a shortage. And that's what's happening at this point. So once this episode is done, you're going to see, I think it will only probably take 60 to 90 days. You'll see new highs in both gold and silver from wherever the bottom is. And I don't think it's going to be much further from where we are right now. I think really what's of concern, the canary in the coal mine right now is private credit. I mean, that's blowing up. You've already seen commercial real estate get hit, and obviously the debt behind that. But the private credit markets, there's 3 or 4 hedge funds now, sponsored by big name banks, Blackstone, BlackRock, that have gated investors. In other words, you want $100 out, but they'll only give you $7, or you want $100 out and you can't get any. So it's a problem. And from an additional standpoint, it's a mental problem, because that's the way bank runs get started. That's what happened in the California banks. What was it, 2-3 years ago? And those came out of nowhere. This is very reminiscent of Bear Stearns in February of 2007 with their 3 funds that they gated. And what was it? It took a lot longer than I thought back then. It was a year, call it a year and a half, before everything unwound. But that was definitely a signal as to what's coming. And I think private credit is telling you that also. And on top of that, yields all over the world are beginning to rise.
The global financial system is built on a growing pile of debt, and as interest rates rise, that foundation becomes weaker and more unstable. The higher the cost of borrowing, the harder it is for governments, companies, and individuals to keep up, increasing the risk of cracks forming across the entire system. Unlike paper money and most financial assets, physical gold and silver don't depend on anyone else's promise to pay. They can't go bankrupt or default, which is what makes them stand out in a world where many parts of the system rely heavily on trust and credit. Even though their prices can move up and down in the short term, gold in particular has held its value over time and has highlighted how much purchasing power currencies like the dollar have lost over the years. Some of the recent price drops in precious metals are often influenced by paper trading and derivatives rather than real physical demand. For long-term investors, these pullbacks can be seen as opportunities to accumulate assets that act as protection against financial instability.
It's the entire system is based on debt. Debt is now the foundation to the whole system. The problem with debt being the foundation is when interest rates go up, the foundation gets thinner and thinner and thinner until it cracks. And just to go one step forward, the reason you want to own gold and the reason you want to own silver is because they cannot bankrupt in a world that is going to completely bankrupt. The foundation of the world, because it's based on debt, and I mean, debt is debt defaults, and debt will default, and that's what people are going to find out, is that there's no foundation under the entire system, both the real economy and the financial markets. I mean, yeah, if a pension goes out of business or 2 or 3, yeah, they can probably backstop that. Can they do that if the entire system goes? No. It's a joke. Your true CDS, your true insurance policy is physical gold and silver. End of story. Because they cannot default and they are real money. And when this thing goes, you're going to have capital from all over the world trying to find the last safe havens that can't default. And by definition, gold is money and silver is a hybrid money, but neither of them can default. And they will be, and we talk about this, me and Jim talk about this many, many times on interviews. They will be, gold and silver will be the last men standing. Well, I mean, it's absolutely critical because there's more debt in the world, obviously on a total basis. There's no question about that because the system's bigger than it's ever been. But there's more debt per GDP. There's more debt per any ratio that you want to look at. And when you have a system that's saturated in debt, if you raise interest rates, the system chokes. Look at the Federal Reserve. Look at their balance sheet. It was just 3 years ago I looked at it and they had $65 billion total in equity, holding the whole system up, holding their portfolio up. But they now have a negative net worth, and that's because they unloaded all sorts of called lower rated bonds that they've held on to, and just the regular U.S. Treasury portfolio. As interest rates go up, the bond values or prices go down. And I think they're between $100 and $200 billion net negative equity at this point. And I mean, follow that through to all the insurance companies. The insurance companies, they probably have 60, 70% plus of their portfolios are in bonds. And that's what is the bedrock to these companies having value, to these companies being able to service the life insurance contracts, the property casualty contracts, etc. So higher yields and lower bond prices in a over-leveraged system becomes a disaster at some point.
Holter's message grows increasingly urgent and straightforward. He cautions that if this system starts to malfunction, users might not be able to access their money from brokerage accounts, banks, or even insurance plans. Furthermore, the value may already be much diminished even if they could obtain it. He emphasizes that a crucial legal fact that many people are unaware of is that when you deposit money in a bank, you are actually lending it to the bank. This implies that you might lose everything and be treated like any other creditor if the institution fails. He links this concept to what he refers to as the Great Taking, contending that financial organizations are already allowed by law to put their own survival ahead of the safety of their clients. Put differently, the danger is inherent in the system and is not only speculative. Holter also raises concerns about the dependability of so-called insurance systems, pointing out that no one could be able to step in to cover losses if someone as big as the U.S. government were to experience severe financial difficulties. In general, he warns that most individuals are unaware of how vulnerable the system is. Rising debt, increased interest rates, and limited funding availability might all set off a domino effect. His main point is that in a real crisis, access to your money and the security of your assets might not be guaranteed, so it's important to be prepared and informed of how the system operates.